Welcome. Whether you're joining us from Mumbai or Sydney, Shanghai, or Seattle, we're glad you're here. While our audience spans the globe, we'll be using U.S. market data for our examples today since it's well documented and researched. The principles we'll discuss apply universally, even if the specific numbers may vary in your local market. Ever feel like you're working harder than ever, but your bank account doesn't show it? You're not alone. While our paychecks might be getting bigger, many of us are actually getting poorer. Why? Because there are hidden wealth killers silently draining our money every day. Let's expose these financial assassins and learn how to protect ourselves from them. 1. The car loan trap. But I deserve a nice car. This mindset could destroy your financial future. Let's look at a real example of how a $50,000 new car loan becomes a wealth-destroying monster. With a typical 72-month loan at 7% APR, your monthly payment would be around $850. Sounds manageable? Think again. Over those 6 years, you'll actually pay $61,200 total. That's $11,200 in interest alone. And we haven't even talked about insurance, maintenance, and depreciation yet. Want to lower those monthly payments? Some dealers will offer 84-month or even 96-month loans. But here's the brutal truth. By stretching the loan to 8 years at the same rate, you'll end up paying $13,000 in interest. That's right. You're paying over 25% more than the car's actual value. How do you know if a car fits your budget? Here's a simple rule. Multiply your annual income by 0.35. That's your maximum car budget. So, if you make $80,000 per year, you shouldn't spend more than $28,000 on a car. Period. If you're looking at a $50,000 vehicle, you need to be making at least $143,000 annually to justify that purchase. The smart move? Look for a reliable used car that's 2 to 3 years old. You'll avoid the massive depreciation hit new cars take in their first years, and you can find great deals around $15,000 to $20,000. Your future bank account will thank you. 2. The divorce disaster. While the emotional toll of divorce is immeasurable and devastating for both partners, today we'll focus solely on its financial impact. But we're in love. We don't need to talk about money. This naive thinking leads many couples straight to financial ruin. Here's a sobering fact. Marriage laws are filled with regulations about responsibilities, obligations, and property division, but not a single line about love. Let's face reality and look at the real numbers behind divorce's devastating impact on wealth. A typical divorce in America costs $15,000 to $20,000 in legal fees alone. But that's just the beginning. Studies show the average person's wealth drops by a staggering 77% after divorce. For a couple with $100,000 in assets, that means being left with just $23,000 each. And the bleeding doesn't stop there. Ongoing alimony payments can eat up 30 to 40% of your income for years. Add child support payments that average $430 per month per child, and your financial future starts looking very grim. Want to protect yourself? Here's what smart couples do. Get a prenuptial agreement. It's not unromantic, it's responsible. Have monthly money dates to discuss finances openly. Keep some financial independence while sharing major goals. Build an emergency fund specifically for relationship troubles. Remember, love is beautiful, but marriage is also a financial partnership. Treat it that way from the start, and you'll have a much better chance at both romantic and financial success. 3. The credit card monster. Credit card debt is the perfect financial assassin. Silent, patient, and deadly effective. Like a skilled hitman, it strikes when you least expect it and kills your wealth so quietly you barely notice until it's far too late. The average American household carries $6,270 in credit card debt. But the true danger lies in how this debt operates. With interest rates ranging from 15% to a staggering 25% APR, your seemingly manageable debt becomes a lethal weapon against your financial future. Just like a slow-acting poison, the interest compounds daily, gradually draining your wealth while you remain blissfully unaware. The credit card companies are the masterminds behind this sophisticated assassination. They lure you in with seductive minimum payments, typically just 2 to 3% of your balance. It seems merciful at first, only $125 monthly payment on a $6,270 debt. But this is where their true genius shows. At 20% APR, that manageable payment schedule stretches into a 6.5-year death march, during which you'll pay an additional $4,688 in interest, nearly doubling your original debt. The killing blow comes from multiple directions. Late fees strike like throwing stars at $35 to $40 per hit. Over-limit fees ambush you for another $35 to $40. And if you stumble, penalty APRs as high as 29.99% descend like a final sword stroke. Your credit score takes collateral damage, affecting every future financial move you attempt to make. Multiple cards multiply the danger, like facing an entire clan of financial ninjas. Balance transfers might seem like an escape route, but they're often just another trap, leading you deeper into the assassin's lair. The compound interest works in darkness, calculating its attack every single day, whether you're watching or not. To survive this silent killer, you must be equally ruthless in your defense. Pay your statements in full every month without exception. Switch to cash for discretionary spending to make your expenses visible and tangible. Develop an aggressive debt elimination strategy and stick to it like your financial life depends on it, because it does. Consider cutting up your cards until you're debt-free, keeping only one or two for genuine emergencies. Remember, credit card debt is the most patient assassin in the financial world. It doesn't need to strike quickly. It's content to bleed you slowly, dollar by dollar, until your financial dreams lie dead on the ground. Don't let this silent killer claim your future as its next victim. The impulse shopping disease. Your smartphone isn't just a device, it's a weapon of mass financial destruction, armed with algorithms designed to separate you from your money with surgical precision. Like a skilled pickpocket working in broad daylight, it slips into your wallet while keeping you entertained. The average American makes 156 impulse purchases per year, totaling $5,400 annually. That's $324,000 over a working lifetime, enough to buy a house in many parts of the country. Instead, we're trading our future homes for temporary dopamine hits from packages at our doorstep. The attack vectors are everywhere. Instagram's AI knows your style better than your spouse. Amazon's Buy Now button is basically financial Russian roulette. TikTok's Shop Now feature hypnotizes you into buying things you didn't know existed. Target's app remembers everything you've ever looked at, waiting to strike with a personalized deal. It's like having a professional shoplifter living in your pocket, except this one steals money from your pocket. And the worst part? We willingly hand over our financial security for the privilege of being marketed to 24/7. Want to survive this digital shopping apocalypse? Here's your battle plan. Implement the 72-hour rule. If you still want it after 3 days, maybe it's not just impulse. Unsubscribe from all shopping emails. They're financial spam with better graphics. Delete shopping apps. They're just slot machines disguised as convenience. Block shopping sites during vulnerable hours. Yes, 2 a.m. shopping is never a good idea. Remember, every time you hit Buy Now, somewhere a financial advisor weeps. Your smartphone should be a tool for building wealth, not destroying it. Make impulse shopping as outdated as dial-up internet. Your bank account will thank you. The no financial plan. Nightmare. In today's volatile economy, flying blind with your money isn't just risky, it's financial suicide. With layoffs hitting every industry, inflation eating away at savings, and market uncertainty becoming the new normal, not having a solid financial plan is like skydiving without a parachute. Think about it. No emergency fund in a recession. Key duck, sleepless nights, and constant panic. Retirement planning delayed. Key buck, working until you're 80. Zero investment knowledge equals watching inflation steal your savings. Living paycheck to paycheck equals one emergency away from disaster. The brutal truth is that hope isn't a strategy. The days of, "I'll figure it out later," are over. Without a clear financial roadmap, you're not just lost. You're actively moving backwards while inflation sprints forward. Your battle plan for survival. Build 6 to 12 months of emergency savings. Yes, 12 months in this economy. Start retirement planning. Today, not tomorrow, not next year. Learn basic investing principles. The market rewards the patient. Track every dollar like a hawk. What gets measured gets managed. Create multiple income streams. Never depend on just one paycheck. Remember, the best time to start planning was 20 years ago. The second best time is right now. Your future self is either going to thank you or curse you. The choice is yours. 6. The house poor syndrome. The dream of homeownership can quickly become a financial nightmare if you're not careful. Like a predatory lender lurking in the shadows, the house poor syndrome waits to trap unsuspecting buyers in a prison of their own making. Think about it. You finally get those keys to your dream home, but suddenly, your entire paycheck is devoured by the mortgage loan payments. Basic home maintenance feels like luxury spending. Property taxes and insurance, where applicable, hit like unexpected assassins. You're one major repair away from financial disaster. Your investment has become an anchor dragging you under. The math is brutal and unforgiving. Every $100,000 borrowed equals approximately $500 to $600 in monthly payments. Property taxes, in countries that have them, can add significant costs. Insurance, utilities, and maintenance drain your income further. Building fees and community charges can be the final nail in your financial coffin. Your defense strategy must be ironclad. 1. Save a substantial down payment, 20% or more if possible. 2. Keep total housing costs under 30% of take-home pay. 3. Build a separate emergency fund just for home repairs. 4. Start modest. Your first home doesn't need to be your forever home. 5. Remember, bigger property equals bigger problems. The real estate market is like a casino. The house usually wins. But you can beat the odds by buying less property than you can afford. Treating appreciation as a bonus, not a guarantee. Understanding that real estate prices can fall. Global financial crisis taught us this. Never using your home as an ATM through refinancing. Remember, a house should be a home first, an investment second. Don't let the property dream become a financial nightmare. Your perfect house is the one you can actually afford to live in while still building wealth elsewhere. Here's the scary part. These wealth killers work together. That car payment makes it hard to save for a house. No savings leads to credit card debt. Credit card debt makes divorce more likely. It's a vicious cycle. But here's the good news. Now that you know these enemies, you can fight back. Start by tackling one wealth killer at a time. Your future self will thank you with a healthy bank account and real financial freedom. Remember, getting rich isn't about making more money. It's about keeping more of what you make. Don't let these wealth killers steal your financial future.